Hello and welcome to the Global View, the show where we look at ways for investors to make money beyond the ASX listed universe. I'm your host, Juliette Sali. Well, global stocks have eased as US bond yields surged amid a global market sell-off in longer-dated bonds driven by war-related inflation concerns. The S&P 500 and tech-heavy Nasdaq fell for a third consecutive session, with investors locking in profits following the sharp rally that began in late March. Markets also weighing the risk that the Federal Reserve's next move could be to raise interest rates if inflation remains elevated. 6 of the 11 major S&P 500 sectors ended lower. Tech and communication services among the biggest index point drags, and materials the biggest sector decliner, while the defensive healthcare sector led gains with a near 1% advance. Now, the retreat came despite Bank of America's latest monthly survey of global fund managers, showing investors remain firmly, quote, in it to win it, with equity allocations posting a record jump and cash holdings falling sharply as optimism over earnings growth and higher interest rates surged. Investors are waiting anxiously for AI chip leader Nvidia to report quarterly results after the bell on Wednesday. Shares fell ahead of that, weighing down the broader semiconductor sector on profit-taking following its recent massive rally. Home Depot, though, rose after beating Wall Street profit forecasts, but same-store sales metrics missed some analyst expectations. Akamai Technologies was down by more than 6% after the cybersecurity company announced a $2.6 billion convertible note offering. And Verisk Analytics surged roughly 19% before easing into the close following a strong after-hours earnings report. Well, US President Donald Trump has indicated the US could still strike Iran, revealing he's come within an hour of approving military action before delaying such a decision. The comments came a day after President Trump said he'd paused plans to resume hostilities following a fresh proposal from Tehran aimed at ending the US-Israeli conflict. Quote, "I was an hour away from making the decision to go today," Trump told reporters at the White House. Well, the yield on the benchmark 10-year Treasury note surged to as high as 4.687%, its highest since January 2025. But the 30-year Treasury bond yield, which is seen as a barometer of political risk, climbed to 5.197%, its highest in 19 years. The US dollar up in part because of higher yields driven by inflation fears and uncertainty over how new Federal Reserve Chair Kevin Walsh will respond if price pressures continue to accelerate. Gold prices down more than 1% on that firmer US dollar, and as persistent inflation fears keep interest rate hike expectations and Treasury yields high. Spot gold holding just above $4,500 US an ounce by the end of the session after falling to its lowest level since March 30 earlier in the session. Brent crude prices holding above $110 US a barrel, with prices elevated on supply concerns, fanning those worries of rising global inflation with fuel costs surging. And Bitcoin is holding just under $77,000 US a coin. Joining us for more is Peter Cardillo, Chief Market Economist at Spartan Capital Securities. Great to see you, Peter. Now, you've been in the game for a long time. With the 30-year back to where it was pre the global financial crisis, how worried should we be?
I think we should be quite worried because what we're seeing here is a war-related inflation. And that inflation is spreading across to other sectors besides energy. And so the chances of the new Fed chairman, Mr. Walsh, lowering rates is probably now 0, as opposed to maybe a 50% chance of the next change would be a rate hike. And I think this is what the market is pricing in. And of course, the problem is the war factor. If the war continues to drag on and energy prices continue to move higher, there's no way we can escape a tightening by the Federal Reserve. And that's not only by the Federal Reserve. That'll be pretty much across the board. In fact, if you looked at what happened in Japan, if you looked at the GDP in the first quarter, it came in a little higher than expected, and that's basically setting the path for a rate hike in Japan. So it's possible that Japan goes first and we go after Japan.
All right, so when we look then at the worries in the bond market, so far equity markets have held up pretty solid. I mean, we did see a dip overnight, but you say that the market here remains largely resilient.
It does, and the reason for that is because we've come off of a very solid earnings season, and it was coupled with strong guidance, and so that's the basic fundamental of the stock market. So until that begins to change course, then I think the market will have pullbacks. There's no question about it. We had a few over the past few days, but I think that, by and large, it's still quite resilient. It's just like if you take a look at the American consumer, for now, the higher inflation in the upper end of the earnings market has not really weakened consumer spending. But of course, if these prices remain elevated and we see higher energy prices, and of course the higher energy prices means prices spreading to other sectors of the economy, you can rest assured that that heavy tax of inflation is going to bite into the consumer spending, and obviously weaken consumer sentiment to the point where then it would become a problem for the markets.
Yeah, and you get that concern about what sort of cracks could start to be happening since. We have heard that little movement that maybe there could be some congressional or impact on President Trump trying to bring an end to this war in Iran. What does that do then, Peter, for the oil price?
Well, even if the war were to end tomorrow, which it doesn't look like it's going to happen that quickly, in order to get the Strait of Hormuz back up and get that 20% of the world's oil that flows through there back to a normal pace, it's going to take a few months. So that means that oil prices are likely to remain elevated, somewhere between maybe $90 and $100 a barrel. Otherwise, if the hostilities begin again and the war prolongs, we're probably looking at $150 a barrel of oil, and that means much higher inflation at both the producer's level and, of course, at the consumer's level.
The other factor is what it means for safe havens. What are you seeing with regards to where gold's tracking?
Well, gold, the precious metals right now are a little bit under pressure, and the reason for that is because you have yields that are moving higher, and the prospects of the Fed probably to raise rates, and of course that also boosts the dollar. So the higher level of the dollar and the higher level of yields and the prospects of a rate hike certainly wanes on precious metals. But for the longer term, I still believe that gold has a long way to go, and I'm still looking for 6,000 by the end of the year.
The other key thing, I guess, is that we're keenly awaiting Nvidia results. They're really going to have to blow it out of the park here, Peter, to excite investors. What's your take on what we might see during the next session for equity markets, given this key focus on Nvidia?
Yeah, well, it all depends. And, of course, many of the tech stocks are priced to perfection. So they need to come in with earnings that's going to satisfy the market. Otherwise, we could see more negativity develop over the next day or two.
All right, Peter, we'll wait and see. Thanks, as always, for your insights. Peter Cardillo there from New York, market economist at Spartan Capital Securities. Well, looking ahead in terms of what we're expecting, where the local market is set to open, SPI futures are down by around 0.5%. We have had some earnings coming through from the likes of Catapult and also James Hardie. We'll get you across all of those with the open coming up next. We'll see you soon.